Okay, you have to go ahead and accept that. And my recollection is that we had ended at module 6, and there are a couple of modules that deal with financial valuation methods. I'm going to ask that you take the time to look at that using the Becker lecture software, and that most of the discussion there is looking at various formula that would be used to value a company, what should be paid essentially for a share of stock for a company. I don't see a whole lot of use in me sitting here and just calling out formula to you and then showing you how to apply numbers in a problem setting to those formula. That's something that is best practiced on your own. However, I do recommend that as you go through that section, you absolutely go ahead and flashcard and memorize the formula so that you get a handful of questions asking you to use these various methods to value a company. You are able to quickly plug in the numbers that are given in the problem and then supply the answer, obviously. I think that you'll find that once you have those formula memorized, the handful of questions that you might have to answer, and those will be relatively straightforward for you. Where I would rather go, and what I think is actually more heavily tested on the exam, is all the way to our module on how to analyze and make various capital budgeting decisions in a company. So I'm going to jump us forward past the financial valuation modules to the financial analysis module. And I'm gonna lumber my way over there here to module 8. Okay, and these are modules that we're going to be discussing here. This module is going to be discussing the methods to make different financial decisions, which are more heavily tested on the exam. So let me put us in full screen here. Let me, before I jump too quickly to that doesn't mean I don't want you to look at modules 6 and 7. I want you to look at the pre-recorded lectures on those, primarily though focusing on making the flashcards excuse me, for those various methods that are used to value a company. What we're going to focus on in the back end of chapter 2 here tonight is looking at how do we use different methods to make financial decisions. And we're going to talk about 3 primary methods that are used. We're going to first talk about net present value method, then we're going to talk about internal rate of return, and then we're going to talk about using payback method. Understand something about those, focusing and making sure that we're comfortable with what some of the advantages, disadvantages are to those various models. Again, exam loves to ask those kinds of questions, particularly, excuse me, guys, in a potential written communication question. Sorry. And then finally, looks like I'm going to fight that for a while here. And then finally, we will go ahead and finish up our tonight's discussion by getting into chapter 3. So we should be able to get into chapter 3, at least the first few modules in chapter 3 tonight. Okay, so with that as a look forward, let's go ahead and start talking about, and we're really talking about capital budgeting. And it is a process where a firm will make a decision as to whether or not they want to engage in some sort of long-term project. Maybe they're going to be investing in some sort of equipment and are going to be using these capital budgeting techniques to make those decisions. Now, when we look at these long-term decisions, okay, that an entity may make, and I'm going to go ahead and change the font on that. I don't like the font on that line. It's a little better. We start to look at those long-term decisions, we will consider cash flows, and we can break those cash flows into direct effect. Direct effect cash flows are, for example, the investment that we're going to make, whatever the annual, say, return is going to be on that investment. Those are direct effect. Indirect effects are things, and the primary one there is going to be depreciation tax shield. What happens? I buy a piece of equipment. And of course, I'm going to depreciate that equipment. I'm going to be able to take that depreciation and expense on my tax return. So you have to look at it by buying that equipment. Had I not bought that equipment, I would not have an additional tax deduction that I can shield a certain amount of income from taxes. So that's actually going to increase my cash flow later on as I'm able to take those tax deductions. Okay, so we're going to see that's a good example of an indirect effect cash flow that we will want to consider. So we come over and we start to take a look at something called the net effect, and we give more more credence to this, more importance to this than it really needs, I think. And then when we talk about net effect, it's just the difference between the cash inflows and the cash outflows, and we consider both the direct and indirect cash flows. Okay. Now, usually the inception of the project is when we will make that initial investment. That's usually when the largest cash outflow comes. And then as we move along through the life of the project, we'll see that we'll have the cash inflows coming in. And we would look at the net of those because there could be obviously going to be some cash outflows associated going forward as we have to buy different, supplies or whatever to keep this project going. Okay. Now, one of the ones that I see mess students up a lot is working capital. Okay. So sometimes we'll get involved in a project and there will be a need for an upfront deposit or something. Well, that's going to tie up a certain amount of our cash. That's going to be a cash outflow that'll happen at the beginning of the project. For example, let's say we're involved in some project and the project requires that we have containers for some sort of material. And the vendor says, well, we have to put down a $100,000 deposit over the next 5 years for these containers. At the end of the project, we give them back the containers, they give us back the $100,000. Well, that would be an example of a tie-up of working capital that we'd have to consider that cash flow is going to go out at the beginning. And most of my students don't have trouble. When I say my students, I see this a lot in cost accounting at the university, or sometimes even when I'm teaching introductory and they have this issue come up. Probably more introductory students struggle with this. They remember the tie-up of the working capital at the beginning. But if that working capital is going to be released at the end of the project, say 5 years from now, then it is very important that we consider that working capital is going to be released, and the release of that working capital, we need to come down to the bottom of the page here, the release of that working capital at the end of the project, okay, would be a cash inflow. Okay, so working capital committed once the project is disposed of, a working capital committed that was recognized as indirect cash outflow at the inception would be an inflow at the end of the project, but we would have to discount that to present value. Okay, so usually the cash outflow at the beginning of the project, there's no need to discount. Cash inflow at the end of the project, when the working capital is released, that would need to be discounted. Okay, now the other cash flows to consider are those related to disposal of the asset. Okay, now there could be a disposal of an asset at the end, the one that we're acquiring now, but also we have a current asset in place and we're going to be selling that off or disposing of it. That will also create some cash flow. So let's just look at first asset abandonment. So if the replaced asset, the one that we are currently using that we're going to be getting rid of because we're acquiring this new one, if the replaced asset is abandoned, the net salvage value is treated as a reduction of the initial investment in the new asset. So we're going to maybe sell it off or something. Okay, now let's not sell it off, but we're going to abandon it. The abandoned asset's book value is considered a sunk cost and is not relevant to the decision making. Flashcard that. So we're not looking at whatever we paid for it. However, the remaining book value, okay, so We bought the asset for 100,000, we depreciated it, now it's worth 20,000. We would look at that 20,000 because we're abandoning it, so we're going to write off that 20,000 book value, and that is deductible as a tax loss, which will basically reduce the tax liability for that year. The tax liability decrease is considered a reduction of the new assets initial investment, because we're going to get a write-off there, and that is going to shield a certain amount of income from tax. Really? Is this really going to do this to me? Let's see. Yeah, it sure is. Okay. Let's see if I can get out of this problem simply by exiting full screen and coming back. No. Okay, so let me close the software entirely. Yeah, then it doesn't like to let me even close the software when it starts this nonsense. Okay, well, let me close it. That's a good sign. So let me see now if I can open it back up. I'm going to tell it to discard. Okay, and let me go back to full screen. And let me jump down to where we were. Okay, and we were talking about asset abandonment. Okay, so we're just basically going to get rid of the old asset. And all we were saying there was that as we're getting rid of that old asset, if we're just abandoning it, we're just going to junk it somewhere, whatever, that loss, the remaining book value, would shield a certain amount of income from tax purposes. That's going to be considered a tax, or not a tax inflow, that will reduce the initial investment, since that's going to presumably happen as we at the beginning of the project. Now, if we sell the asset, okay, if a new asset acquisition requires a sale of the old asset and cash is received, okay, it will depend on whether there's a gain or loss, okay, and there's also a corresponding increase or decrease in the tax. So, of course, the cash that comes in, but we will have to pay tax on that if we have a gain associated with that. So if there's a gain, the amount of tax paid on the gain is treated as a reduction of the sales price. If there's a loss, okay, we sell it for, going back to that example that I think it was 10,000. I forget what I said now that was left on the book value, but say we have something with a book value of 10,000 and we sell it for 8,000, well, that's a $2,000 loss, and there will be a shielding of tax from that. Or if there is a gain, then we're going to have to reduce that as the amount of cash that comes in from the sale. So, you know, it's kind of hard to picture all of this because we've got moving parts here. I think as you go through and you look at some of the examples and some of the problems, you'll kind of get used to how to treat those different things. If it's an abandonment, there's going to be a loss. If there's a sale, you got the cash coming in. There's a gain on the sale, then you have to pay tax on that gain. If there's a loss on the sale, then there'll be a tax shield associated with that. Okay. Then, of course, you will have, and we will assume, cash flows generated from the operation. Otherwise, why are we even investing in this particular thing? So you have the cash flow from the operation. Okay, don't forget, when you start to depreciate that new equipment, that is going to have a tax shield for that additional depreciation now because you bought this new asset. If there is, when there is disposal of the project itself, okay, disposal and investment at the end is going to be, the asset is sold, there's going to be cash flow that's going to come in on that, okay? And then there will also be what, if the asset is scrapped or donated, there could be a tax savings associated with that. So again, similar rules that we talked about for disposing of an old asset up front come in when you're disposing of the new asset at the end of the project, with the understanding that we will need to consider time value of money and discount those cash flows that happen later on down the line. We'll take a look at that here in a couple seconds. Okay. Now, we've talked a lot about this tax shield, but let's just go ahead and make sure that we're comfortable with how to calculate the tax shield. And guys, I like method one. I feel that method two. I feel like method one is a little long. Okay, so we're going to look at the net operating cash inflows of whatever's going on, and then we will add the tax shield associated with non-tax expenses, and they say such as depreciation. It's almost always depreciation. And the sum of these two amounts will be the after-tax cash flow. So let's just look at this example, and I'm just going to focus on method two here. Annual cash inflows are 40, the depreciation is 10, tax rate is 40%. So if you take a look, and I'm going to kind of flow into method one to show you method two a little bit here. And we got lined up under method one. You'd have to figure out, well, what am I going to be, gaining from this project, the net cash inflows. But since I'm going to have to pay the IRS 40% of that, I'm only going to get to keep what? 60%. But what's going to happen? They tell me that I'm going to have $10,000 depreciation. That's depreciation that I'm going to have that I wouldn't have had that as a deduction if I didn't buy this equipment. So that tax shield that I have now is actually going to be added to the cash inflows for a pre-tax cash flow of 20. Well, it's not pre-tax here now; it's after-tax 28,000. So that only applies to method one. The after-tax cash flow is 28,000. Now, very important that we are noting that if it's cash inflows, it's 1 minus the tax rate. If it's a tax shield, we just take whatever that additional amount of depreciation or whatever, and just multiply it by the tax rate. That's the part we're not going to have to pay tax on because we entered into this investment. Okay. Okay, good. And then you come over and take a look at the fact that we have to discount. Okay, I'm not going to go through another example that is a little bit overkill. So let's just go through and talk about the discounting that we would have to do. Okay, and when we start to discount, we're going to see that that's going to lead us to the net present value method. Okay, now net present value method is probably the more widely accepted of the different decision tools that we're going to be talking about here. Okay. Now, when we go and we look at the net present value method, we will be looking at cash flows. If we're looking at cash flows, we will be looking, and they'll give you the tax expense that's going to be associated with that. So they'll say, well, this is the income from this, but the depreciation expense is X amount. Well, you'd either need to ignore it if they're asking you to subtract it off the revenue, or if they're just giving you the total expenses and they tell you so much in depreciation, you have to add that back to get what the net cash flow is. So they tell you to ignore it. You can't really ignore it. You need to consider it properly. The other thing that you need to keep in mind with the depreciation, if it is a tax shield, then you would have to calculate the savings for the tax shield along the lines that we've already been talking about. So you will look at these net cash flows, and we're going to practice with some of these things here in a couple of minutes. And depending on what the result of that analysis is, you will make a decision as to whether or not you want to invest in this particular project. So if we have a positive net present value, then you should go ahead and pursue the project. Okay, flashcard that. Now, they say net positive result or zero. You can put or zero. So there might be, in practice, it never comes out to zero. But you know, in theory, in an exam or something, they might put it as zero, and you would accept the project. If the net present value is negative, reject the project. Okay, so I think you know that, but go ahead and flashcard that just so you remember, because you have a lot of things that you're going to be needing to remember here now for your exam, right? So we need to use an interest rate, okay? And they say all rates are determined by management. For example, we talked last time about how to calculate the weighted average cost of capital. Well, that weighted average cost of capital might be the rate that we then will use to evaluate projects, right? And that would be the interest rate, or the discount rate, I guess is a better way to put it, that we would be using here to make these net present value calculations, okay? Now, the rate may be constant in some problems, but in some problems, they may say the rate is so much for the beginning of the project, and then towards the back end of the project, the rate will change, because the longer the project, the more risky it is, right? And then what? As we're all experiencing, inflation could have an impact on interest rates. And so we would maybe be looking forward and say, well, it's this for now, but we're seeing increase in interest rates. Hopefully, maybe, you know, interest rates will come back down once the, you know, the Fed determines inflation is under control or something. I don't know, whatever. Okay. Okay, good. Now you come over and you take a look. The main thing to keep in mind there, guys, is different rates. Okay, you can have different rates that will come up, and you just need to go ahead and discount the cash flows for whatever years that they're looking at using whatever interest rates the problem calls out. Okay, now let's flashcard this, and I've kind of already stated this, and the net present value method is considered to be superior to one that we'll look at here in a little while, internal rate of return, because it's flexible enough to handle inconsistent rates of return, not only inconsistent rates of return or changing rates of return, which is probably more realistic, but differences in the cash flows over the different years and whatnot. So net present value is much more flexible. I think you'll see that particularly when we look at internal rate of return than the internal rate of return method. Okay, so with all that, let's just go ahead and practice a little bit with some of the concepts we've been talking about, now adding in the present value calculations. So let's just look at these facts here, okay, just so we kind of get them in our head as we go through and do this analysis. And so we've got this McLean Inc. is considered a purchase of a new machine, which will cost $150,000. When I look at problems, I always put that down immediately as a cash outflow. So I don't have to keep going back into the problem to see what the initial cash outflow was. There's not going to be any discounting on that because it's going out immediately, right? The machine has an estimated useful life of 3 years. Assume for simplicity that the equipment will be fully depreciated for tax purposes, 30% in the first year, 40% in the second year, and then it goes back to 30% in the third year. The new machine, I'm just going to change up the colors here so this doesn't all start to run together for us. The new machine will have 10,000 resale value at the end of the estimated useful life. Okay, good, cash flow is going to come in, but we're going to be paying tax on that. And the machine is expected to save the company $85,000 per year in operating expenses. Okay, so it's not necessarily this generating revenue, it's doing what? It's reducing our operating expenses, and so we're going to have that cash inflow is what that's considered, because it's saving us money. But again, we're going to have to adjust that for the tax, and so they tell us here that the tax rate is going to be 40%. Okay, And then we use a 16% hurdle rate to evaluate the project. Again, that hurdle rate is something they said is determined by management. Again, it might even be at the board of directors level, where they say, if you're going to invest in a project, we need a return that's going to be 16% or more. And again, they maybe use the weighted average cost of capital or one of those other tools that we talked about in the previous lecture here for chapter 2 to come up with that rate. Now, the problem will give you the rate, by the way. I'm going to need to scare you to make you think that, oh man, they're going to make us first do the weighted average cost of capital. And they could do that, but I don't think they will. And we have to figure out the rate, and then we have to go from there. Once they get into net present value method, they're pretty much giving you the rate here, which is 16%. So sometimes in problems, they may give you a couple of different rates, and you have to know which one to pick. Like they may say their borrowing rate is this, but the hurdle rate is 16%. Don't use the borrowing rate. Use what? Use the hurdle rate that was given, because that's how we evaluate projects. Okay, so they give me present value of $1. They give me present value of an annuity factor, and problems will often do that because they want to see if you know when you need to use the discounting for a one-time payment versus a stream of payments. So just looking at this, for this savings of $85,000, the after-tax number, we'll use the annuity factor. For this, 10 grand that's going to come in at the end, we're going to be using the one-time amount. And then for the depreciation tax shield, because the rate changes from year to year, the tax rate changes from year to year, then we will need to use these present value of $1 factors, because we have different years coming in here. So different amounts for different years coming in. So you take a look, and we look at the depreciation tax shield first. Okay, we sort of get that out of the way first. So we have the cost of the asset. Okay, and they tell us the depreciation rate is 30% in years 1 and 3, and in years let's do this, guy. Let me turn this to green. And in years year 2, it's 40%. So our depreciation is going to be 45,000 years 1 and 2, years 1 and 3, and year 2 it's going to be this 60,000. We multiply it by the appropriate tax rate that was given for all the years. The tax rate was the same. Now, if the tax rate changed, then we'd have to use different tax rates for different years, right? But in this case, the tax rate stayed the same. So we've got the tax shield. Okay, good. So that's going to essentially going to do what? That's going to increase our net cash flows for those years. Now, the annual savings, they told me, was what? Was this 85,000, but of course I have to adjust that for after tax, because even though I'm going to be saving money, now I'm going to be paying more taxes. My net income presumably is going to be going up. Then I go ahead and figure out the proceeds from the sale here, which is going to be this 10,000. Okay, but there'll be no basis because they said the machine will be fully depreciated at the end of the 3 years. 10,000 gain, but I have to pay tax on that. So the cash inflow is 6,000. So I got my cash flows. Now I just need to discount them using the appropriate rates that we saw earlier. And again, I always like to write that 150,000 down immediately. I know that's going to be an amount that's going to come out immediately. I just write that down. I know then I'm going to be comparing the cash inflows that will be coming as a result of this project. And that's usually the way the analysis works, the amount going out at the beginning versus the amounts that are going to come in the future. So I start using the appropriate rates. And so I have this, this 51,000 that's going to be coming in per year. I have the tax shields that I calculated above, that's after tax. And then in year 3, I get this 6,000. So I see what they did. And you could have taken the 51,000 and used the present value of the annuity and then just considered the present value of $1 for the depreciation tax shield and the net after tax amount that's going to come in on the disposal. But I see the way they did it was actually probably a little smarter, is they got the cash flows and then they used each of the appropriate rates after that for and considered those, one-time cash flows. Even though 51,000 was an annuity, this was actually a better way to do it. And so when they compare these cash inflows to the cash outflow, which we of course don't have to discount because that's coming out as one, we sit here now and we have this 13,278. So should we do the project? Yeah, we do the project because it has a positive net present value. Okay, question. Okay, good. Now, again, pros and cons, limitations, advantages, disadvantages. The major advantage, and why don't we flashcard that, is its net present value method is flexible. We can do a lot of different things with it, different depreciation rates, different interest rates, so on, different tax rates, although we didn't see that in that problem. All of those things can be considered, okay? The limitations, okay, and let's just go ahead and take a look at that. Even though it's considered the best single technique, the net present value method of capital budget is limited by not providing the true rate of return on the investment. The net present value method purely indicates whether the investment is exceeding a hurdle rate or not. Okay, so it is a way of screening the project, or maybe even ranking projects. We'll look at that here in a couple seconds, but it's not actually telling you the return. But I don't see that that is as big of a problem because we're looking forward and we're estimating anyway. You'll be able to see the actual return on that project. I mean, nobody knows what the return on any investment is going to be until after you make the investment and you start actually seeing what the returns are. So it is a good way of screening, and you're shooting for that hurdle rate. Whether it comes in below or above that is historical data as opposed to budgeting projected data. Okay, good. Now we come over and limited capital. Okay, companies don't have unlimited capital to go, generally they don't, to go and pursue every single project that has a positive net present value. So we could use, did I tell you the flashcard limitation? Yeah, okay. They could have a situation where they say, well, rank the projects, and you can rank them as those with the highest net present value to the lowest positive net present value. Positive, we'd be looking only at positive projects. And then you just simply go down the list and pick off projects until you run out of capital. Okay, so it could allow you to rank projects and figure out which projects you want to take and which ones you do not want to. Once you run out of capital, which ones you won't take. Now, you could do it just based on the absolute dollar amount, but another way of doing that is by using something called a profitability index. And the profitability index is the ratio of the present value of net cash, future cash inflows to the present value of the initial investment, which, by the way, guys, is usually whatever the investment is, because usually that's coming out at the beginning. Okay, so what happens? The profitability index takes the present value of the cash flows, divides that by the cost of the initial investment, and then you're going to take those that have the highest profitability index first until you run out of capital. Okay, so flashcard that profitability index formula, not a very difficult one, but go ahead and flashcard that. And then let's just go ahead and start to take a look at the actual application of the profitability index. And they tell us here that the profitability index measures cash flow return per dollar invested. The higher the profitability index, the more desirable the project. So let's just go ahead and flashcard that notion. And then let's just look at the rest of these, though. The rest of this paragraph, the project that meets the screening criteria, positive net present value, are ranked in descending order by their profitability index. Limited capital resources are applied in order to the index until resources are either exhausted or the investment required by the next project exceeds the remaining resources. So they give us an example here and they tell us, look, this Beeman company, whatever, it's only got 50,000 of capital to invest. And they're trying to decide, well, which things should I invest in? So they go ahead and they start to calculate these profitability indexes. So they have the initial investment and then the present value of the future inflows. And so they go ahead and they list all those. And then they come down and they start to calculate the profitability index by taking what the future flows are and dividing that by the initial investment and coming up one by one. That's a divide, right? By the profitability index. So they calculate those and then they go ahead. And now that we have a profitability index, we start to rank the projects by their respective profitability index. So when you look, project B is 1, right? 1.75. Project E over here is 2. Okay, project, I'm not going to go through every one of these. A is the third one, and so on, right? Okay, so we just look at those, we rank them, and then we start saying, okay, what happens if we do the first 3, B, E, and A? B requires what? It requires us to invest 4,000, 25,000 for project E, and then 16,000 respectively, and we're up to what? 45,000. Now, if we looked at the fourth project here, which is project D, we'd have to what? We would have to come up with 8,000 more of capital. Well, that's going to what? We're not going to be able to do that because 45,000 plus 8 will take us over. What's that? 53,000. That'll take us over the 50,000 threshold. So we would only pursue projects B, E, and A, assuming we had limited capital of just this 50,000. Okay. Question. Okay, good. So with all that, let's go ahead and let's look at a couple of questions here. Okay, looks like most of us have had a chance to try that one. And most of us got it right. There were a couple of folks that wanted A. So let's look at this question 1 and look at what they're asking us. And in equipment replacement decision, which of the following does not affect the decision-making process? And some of us wanted A, current disposal price of the old equipment. No, the disposal price of the old equipment is going to bring in some cash flow to us because we're going to be disposing it. So we would consider that as a direct reduction off of the initial investment. But then we need to consider, well, are we going to pay tax on that because it's a gain? Or will there be a tax shield because there's a loss? We sell it for more than book value. That's going to create, additional tax that we have to pay for the gain. If we sell below book value, that's a loss. It'll create a tax shield. So no, we would absolutely consider the current disposal price. The correct answer that most of us got was B, and B, ends up being the sort of default answer. Although I look at this and I'm like, well, the original fair market value of the old equipment, I'm assuming that if we bought that sometime back, we paid fair market value when we bought the thing, and that does enter into whatever the remaining book value is. So, I don't really care for choice B being there. I think they could have come up with something else. But A, C, and D absolutely are. I see what they're talking about there, the original fair market value of the old equipment being the most likely one that would not affect it. But again, well, what did we pay for it? Something other than fair value when we got the equipment? I don't think that that's typically the case in business, but okay. I can see why B is the correct answer, because A, C, and D are absolutely considered in the decision-making process. Anybody have a thought on what I'm saying about B? Okay. All right, good. Let's go ahead then and let's take a look at the next question. Okay, looks like most of us have gone ahead and selected our answer. So I'm going to go ahead and end the poll. And let's just take a look at this particular question. Okay, 67% of us got it correct. Okay, the choice is D here. But let's look at this because we did have some folks looking at, looks like A had some popularity, as did B. But let's just go ahead and let's take a look. And when the risk of an individual components of a project's cash flow are different, okay, risk component means we're going to be adjusting what? We're going to adjust the discount rate for those risks, right? The longer the project, maybe the more risky. So we might want to use a different discount rate for years that are further out in the analysis, for example, right? An acceptable procedure to evaluate these cash flows is to A, compute the net present value of each cash flow using the firm's cost of capital. Well, A is problematic in that that considers what? That considers a constant rate of return, the firm's cost of capital. We're not seeing that they're implying any sort of adjustment for risk there. So no, A is not right. B, compute the internal rate of return from each cash flow to its risk. And I have to be honest with you, I don't even know what the hell they're talking about there. Utilize the accounting rate of return. That's not going to adjust that. Discount each cash flow using a discount rate that reflects the risk. Yeah. So maybe for the first few years of the project, we use one discount rate. For the back end of the project, we use different, probably a higher rate as the project maybe goes on into later years. Okay. Okay. Come over and let's take a look at, the problem with B. I mean, I still don't know what they're talking about, but the problem with B is that, and we're going to see with an internal rate of return, we simply calculate what the rate of return is, and then we compare it to a constant number, which we have determined is our hurdle rate. And so it wouldn't work to calculate internal rate of return from each cash flow to its own risk. That doesn't make a whole lot of sense. Okay, let's take a look at number 3. Okay, looks like we've had a chance to take a look at this one. So let's go ahead and end the poll. And good, most of us got this one correct. There were a couple of folks that wanted to look at A or B, consider A or B, but let's, so most of us got it right, but a couple of folks were looking at A or B, but let's just go ahead and take a look at this one. And what do we have here? The net present value of capital project is positive. This indicates, and if you read A too quickly, then you might have picked that present value of cash outflows exceeds the present value of the inflows. Other way around, the present value of the inflows exceeds the present value of the outflows. That's what's going to give you a positive net present value, right? B, internal rate of return is equal to the discount percentage rate used in the net present value calculation. No, if the internal rate of return is equal to the discount percentage rate used, then the project will have a 0 net present value. So A is opposite, B is incorrect because it says it has a positive. Present value index would be less than 100%. I don't know what that means. D, rate of return for this project is greater than the discount percentage rate used in the net present value. Yeah, okay, that's going to be correct. The rate of return for the project is greater than the discount percentage rate used. That's going to give us a positive net present value. And of course, we would pursue the project. Okay, good. Let's go ahead and let's take a look at number 4. Okay, let's go ahead and wrap this one. Well, I'll give you a little more time because it's got a couple of calculations in it. Go ahead, guys. I'll give you a couple more seconds on this. Okay, we're coming up on about 3 minutes, and of course, we should never spend more than 3 minutes with the question when we're on the exam. When you're doing your homework, it's okay, but on the exam, we need to be, thinking, hey, after about 3 minutes, we've spent enough time on a particular question. So we got 58% on here, and maybe for the correct answer, which is C, and maybe you guys can help me to understand some of these others because maybe I'm too close to this stuff to be able to understand some of the other choices. So how did you get the couple? I think 2 people picked A. How did you get A? Because I was trying to sit here when I saw someone picked A and I couldn't fathom it. How'd you get A?
I'm on my phone and I really can't see the question. So I just kind of shot that out there. Once I get the poll, it covers up the question, unfortunately.
Okay.
So I just kind of shot it in the dark.
Okay, so it's a completely random guess
Yeah,
without seeing the information. Okay.
yeah, I'm
That's a
gonna
good
move to
one.
my,
That's a
I'm
good
gonna,
honest. Yeah, well, that makes me feel a little better because I'm sitting here, I'm like, hey, I can get it.
no, that one's
Any-
on me. That's not on you.
Okay. Anyone else on A? Because we had two folks. Okay, all right, good. Thank you for sharing that. Okay. I can't remember now. I'm gonna close the poll, but so let's just look at this one. Where maybe some of the other ones came from, if you want to join in on those. So what happens? When I get a problem like this, like I was telling you, the first thing I do is I know that the initial investment is going to come out at 1,800,000. Okay, so the way I like to set these up, and I think this is kind of consistent with how we saw it a little bit in some of the examples, I put down the cash flow, and then I give myself a place to write in the factor, and then that's going to give me the present value. Okay, now that initial cash flow, the factor is kind of perfunctory, if you will, because the entire amount is going to come out at 1,800,000, and we're going to discount that with one. It's not even a discounting because there's, that's coming out immediately. Okay, then I look and they tell me, and this question was kind of a, easier question because they didn't make me consider any tax shields or tax rates, after tax amounts here. So that was good. I need to consider that here. So I have this 420,000 that's going to be coming in on this project, presumably while I'm doing it. And it's consistent for years 1 through 5. And they give me the present value of the annuity for 5 years. So I go ahead and I pick up that factor. And of course, I'm multiplying here. So I get this 3.79. Okay, and so I go ahead, and when I get the 3.79, I have this 1,591,800. Now I don't know if any of the choices that were provided just compared those two numbers. This would give me a negative net present value. So I don't know if one of these negatives worked. Okay. Anyway, then I have to consider the fact that I'm going to be getting back, and they tell me that I can sell this thing for 100 or not. Oh, I'm sorry, it's not selling, excuse me. There's 100,000 for that last year, and that's one of the benefits of the net present value method is you can consider different cash flows for different years. So that 100,000 is for year 6, and they give me the factor of present value of just that one amount that we're considering here that'll come out at the end, and we multiply that times 0.56, and the present value of that is a $56,000 inflow. And then when you go ahead and you consider everything there, this project has a negative net present value of, is it 152,200, the correct answer? Okay, so I of course would not take that project. So I'm not sure how the other ones came in, guys. It starts to become a little bit hard for me to start to, and maybe in the Becker answers, they explain why the wrong ones were wrong. The other ones were wrong. So question? Okay, good. So let's come over and let's take a look at module 9. Now I find this flow chart a little annoying here because we're trying to decide whether or not we're going to lease or buy the project, and we pick which either one has a lower cost, okay, the buying or the leasing. Okay, so we're going to have to make that financing decision. We're only going to take projects with a positive net present value, but in figuring out how to finance that, whichever one has the lower financing cost obviously is going to yield the higher net present value, and that would be the project that we'll take. So when we look at this financing decision part, okay, that's where I think we're more interested in this part of it, because we've already understood only take those with positive net present value. We discount the cash flow specific to each financing option Okay, and again, we use the after-tax amounts, cost of the debt, either the financing or the leasing. The preferred financing option is the one with the lowest net present value of cost. That's the highest net present value, because we're doing these projects to gain some some operating savings or some additional revenue, and revalue cash flows to consider. And we have to consider, when we're buying the asset, purchase costs, tax savings of depreciation, and scrap proceeds, because we're going to actually have this asset and then be able to sell it later, own this asset and be able to sell it. If it's leased, what are the lease payments? But because the lease payments are tax deductible, what are the tax savings on the lease payments? Okay, so this is really, financing decision. We're only going to take projects with a positive net present value. So if they give me two financing options, go through the steps here to figure out the financing costs, and then what? Then just sit there and compare the two net present values. And obviously the one with the lower financing cost is the one that we will take. And of course, we'll only take projects that have a positive net present value. So you come over and you look at this fact pattern for the lease or buy. Okay. And let's just go ahead and let's take a look at this. And we got this boulders considering the acquisition of a new machine, either through an operating lease or by purchasing the asset. The asset will cost $200,000 and have a scrap value of $25,000. Operating inflows are going to be $150,000 for 2 years. Tax rate is 30%. And the weighted average cost of capital is 9%. That's what remember we said there are different ways that they can come up with the cost of capital, but this is what the board of directors has determined. If we're going to make an investment or project, this is the cost of capital. We got to get a return of this amount or greater, right? Greater meaning we'd have a positive net present value. The machine is depreciated, okay, which is going to be relevant if we decide to go ahead and buy the equipment. And Boulder's financing options, using a bank loan at 10% to buy the equipment, or leasing the equipment for $92,000 a year with lease payments due, and the lease payments are due at the beginning of the year. So we take a look and we have this 9%, right? So we're sitting there and we're evaluating whether or not we're going to do this project. We need to use this for the cash inflows, but we have to also consider what the lease payments, and we're using an annuity due here because they told us that the lease payments come out at the beginning of the year. So when lease payments are coming out at the beginning of the year, cash flows are happening at the beginning of the year, you use what? Annuity due. If we're considering end of year inflows, we use the ordinary annuity. And a problem could give you the present value, to confuse you, the present value of an annuity due at 9%, the present value of an ordinary annuity at 7%, as well as what you see here. And then we would have to know which ones to choose for which situation here. Okay. Now, they give us the present value also of $1 for these different periods, for these present value of $1 at 7%. Here, because some of these payments, and they're helping us out in this question, guys, because they're giving us these that are related to the lease situation here at picking up that 7% for the lease. So you come over and we take a look at this question. And they want us to determine the operational benefit of the project, determine how the project should be financed, and then determine the net present value. Now, the thing that I would do is I would see that they're giving me this notion of the present value annual after-tax cash flows of $150,000, and then they do the one minus the tax rate, because we have to consider those after tax. That's where that $105,000 comes from. And then we would multiply that times the present value of the annuity due, and we're using the 9% factor there because what? Because we're looking, and that was the required rate of return. That was the weighted average cost of capital in this particular problem. So we use that. That gives us the present value of the inflows, but now we have to consider the present value of the financing. So we take a look and we have the what after tax cost of debt is 7%. We have a tax rate of 30%. They told us we had a 10% borrowing rate on that. So we go ahead and we have the annual tax shield. If we borrow money and we buy the asset, we're going to have a tax shield of 30. After tax inflow from scrap, and that's going to happen, towards the end of the project, 1 minus the tax rate again gives us this 17,500. Now again, the 200,000 is going out now. Then we have to consider the 30,000 tax shield for year 1 is going to be multiplied times that 0.935. So that gives us that 28,000, and there'll be a tax shield. And then the tax shield for year 2 again is the 30,000, but then we're going to be able to sell the machine and have the after-tax inflow from the scrap, that number up there. So there's that amount for year 3, and we use those percentages. And again, we're using the percentages here that were at the amount that they gave us for the 7% rate of return here. So we use those present value factors. We go ahead and we discount those, and so we have what? We have 130,483, and we're looking, and when you compare it right there, you're like, okay, well, I'm going to keep going with this analysis here to see what's cheaper to do, the lease or the other thing here. And we go ahead and, we'd probably keep going anyway, though, even though that's going to give us a positive net present value. We're going to see if the operating lease is cheaper. So we go ahead and we figure out the after-tax amount that's going to come in from the leasing, which is 92.5, but we have a tax savings there. So after tax, it's 64,750. We pick up that factor, the 1.935, and it turns out that what? This option has a lower cost of capital. So we're going to choose to do the financing. And so after we choose to do the financing, then we have this net present value of 59,404. Okay. Okay. I see the 7%. I was having trouble with where the problem gets 7%. 7% is what? Was a little confusing for me. Even the 7% was what? The 10% interest rate net of tax. So they probably could have made that a little clearer why they were giving us that number here is the 10%, but times 0.7 is where they got the 7%. Okay, good. When we figure out the financing cost there, we use that rate after tax. Okay, good. Let's come over and let's take a look at, we got time for, I think we've got time. You know what, let's go ahead. Let's take the break now. We have time probably for the yeah, let's take the break right now. Let's go ahead and stop there. We'll take a quick break. We'll come back at 6:25. We'll take 10 minutes and we'll come back and pick up here with the internal rate of return. Okay, guys, we're going to go ahead and jump back in, and we're going to start to talk about now the internal rate of return. And when you look at the internal rate of return, and I guess I never pause the recording. So when you look back at this, if you look back at it, you can just have to press forward through the break there. But when you take a look, the internal rate of return method determines the present value factor that yields a net present value equal to 0. So the internal rate of return method focuses the decision maker on the discount rate, which the present value of the cash flows equals the present value of the cash outflows, which is usually the initial investment. Now, let's just think about that for a second as we go through and what happens. We have the initial investment, whatever that is. Right? And then we're wanting the present value of the cash flows to equal the initial investment. That causes the net present value to be what? To be 0, right? And so you come over and you would have whatever the net cash flows are. And they probably would have to give you the information to figure out those net cash flows. They would tell you that's the net annual cash flows. They would tell you the initial investment, and you would multiply that by the present value factor that is going to equal the initial investment. So you look at that and say, oh, okay, if that's the case, yeah, then the net present value would be 0 because the cash flows coming in, the present value of those cash flows coming in are going to equal the initial investment. In other words, the net present value is 0. So you go ahead and you do what? In this scenario, you would divide each side, right, by the net cash flow. So the present value factor will be the thing that you're going to be looking for, and that has to equal the initial investment divided by the what? Net cash flows. That then gives you the internal rate of return. I'm not the internal rate of return. That then gives you the factor essentially, and that factor then you're going to, and they may ask you, and they probably would give you a piece of the table, and you're going to look at the length of the project, and you're going to come over and you're going to find that factor, then you're going to go up, and that percentage that's there, that will give you, that will be the internal rate of return associated with that. And then you would compare that and say, well, is it greater than or less than the hurdle rate? Okay, so you may want to go ahead and flashcard this just to remember if they give you the elements and you have to figure that out. But where the problems tend to focus on is once they tell you what the internal rate of return is, do you know whether or not to accept the project? Okay, and so if the internal rate of return, which again, you come with that factor, they might give you a chunk of table and you're going to have to go up there and look to see what the percentage is, what the rate of return is that's associated with that factor. And if that number is greater than the hurdle rate, then go ahead and accept that project. If it is less than the hurdle rate, and the problem would give you the hurdle rate, then go ahead and reject that project. Okay. Now, limitations. Let's go ahead and flashcard some of the limitations here. And the limitation is that it's unreasonable, they're saying, to say that you would be able to reinvest any money that you get in at that internal rate of return. It assumes that because you're going to get those cash flows and it's going to assume that you immediately reinvest those and get that return. Inflexible cash flows, unlike the net present value method, we are assuming that the cash flows are going to be the same throughout the project in order to get that factor that we then use to come up with that rate. And we've seen that for the net present value method as comparison methods, we could adjust for different cash flows coming in over different times, different rates, et cetera. So it was much more flexible for us. And then the IRR method evaluates investment alternatives based on achieved IRR and does not consider the dollar impact of the project. Okay, so considering those limitations is why, which are solved to a large extent by net present value method, although it also has some limitations that we flashcarded. Those would be some of the limitations. Payback method is really a very simple tool that maybe is used as an upfront screening method that a company might use, and then they're going to go ahead and probably use net present value method once they first considered the payback method as an initial screening. So what the payback method says is how long is it going to take us to recover an investment. Now, I find it kind of interesting here because when you look at this, this almost looks like the same thing. It is basically the same thing that I gave you to calculate that discount factor that you then use to find the internal rate of return. But the number that comes out is looked at very differently in that here, that number that comes out is seen as the payback period. And then you will go ahead and evaluate that against whatever criteria you've assumed. You know, how long does it take us to, you know, recover those cash flows? So let's just look at the initial investment, I should say, but let's just look at this uniform cash flow example. Okay, and we're going to see that there are some similar sort of things that we were doing for the not internal rate of return, but for the net present value method, considering tax shield and that sort of stuff. So I'm not going to repeat all that up there that we are talking about with the tax shield and whatnot, because we've already sort of learned that for net present value method. But we have this project of $250,000 that we're going to be making, and then we're going to consider the net cash flows. Okay, so the expected cash flow, savings, net income increase is going to be 80. The annual depreciation, though, that we're going to be able to take by making this investment means net income before income taxes is going to be 30,000, but we're going to have to do what? We're going to have to pay the tax on that. So we would subtract off the 12,000 from that. So we're going to have what? And so we're just calculating the net income before taxes. So we're basically just getting our tax right here. Okay, so we have that less annual depreciation that we're having now because we invested in that, means we're going to have to subtract the tax. So we take that 80,000 minus the tax you're going to have to pay on that. That gives us 68, and then the 68,000 then divided into the 250,000 tells us we're going to recover until 3.68 years. Now, the limitation here is pretty obvious in that it's assuming that we're going to be getting this 80,000 nice and even each year. Well, that may not be the amount in the case, and often it's not the case when you start to consider non-uniform cash flows, uneven. So they tell us, well, you could take this cumulative approach. And so let's just take a look and see what happens. And we have the 200,000, still the initial investment. And now we're just going to have to look at these cash flows individually to see when will we recover the 200,000. So after year one, we've only recovered 90,000. No, obviously haven't gotten the 200,000. 80,000, we're getting close. We still haven't recovered the 200,000. Year three, and somewhere in year three, yeah, we've recovered the 200,000. So it's going to take us 3+ years. Now, if we want to consider the plus, okay, then what as you know, what's the plus part of that? We know it's at least 3 years, but then we come and we say, well, look, after 2 years, we would have collected all but 30,000. And if we're going to get what in year three, 75,000, assuming the flows are coming in fairly evenly, then what's going to happen at about 40% of the, of year three, okay, then what? then we will have collected the additional 30,000 because we get 75,000, assuming there's even flows during each year. And so during the year, even though each year is different, during the year, the flows are the same. So they would come out with a 2.4 years. If it's a 12-month year, obviously, then 0.4 of 12, whatever that comes to. What's that? For almost 5 months. Okay. Okay, good. Now you come over and let's see what the advantages are of using payback. And it's, advantage is it's easy to use. Okay, and I guess there's an emphasis on liquidity, I guess. Okay, I mean, really shouldn't be so desperate that you got to recover the cash flows in a certain amount of time, but maybe in the early stages of the company that might be relevant. And then you come over and limitations, and you can see that it ignored the time value of money. Project cash flows occurring after the initial investment are not considered. Reinvestment of the cash flows as you get them are not considered, and total project profitability is neglected. We're just looking to see, well, when are we going to recover the investment? And it's not looking at any time past that. Now, you can solve the time value of money issue by simply discounting the cash flows that are associated with the analysis. So just coming over, guys, and I'm not going to read through a bunch of discussion about the discounted payback method when we have an advantage here. I mean, a example here that obviously illustrates the advantages of using the discounted payback method. So now what do? Now we have we have the discount factor for each of the years, and we go ahead and we discount the cash flows. And now when we discount the cash flows, we can again sit there and take the initial investment of the 200,000 and looking at the cumulative now discounted cash flows. What's going to happen in sometime in year 3? We're going to recover those. And so you can see that if you wanted to do that sort of cumulative amount, 200,000 minus what we've got by the end of year 2 versus now, notice we're using the present value numbers here as to how much we would have left to collect versus what we're going to collect on a present value basis. And so we'd have to go all the way practically to the end of year 2 using the discounted method. Okay, so let's go ahead and let's take a look at, we're going to talk about deriving formulas here. You don't have to worry about deriving formulas. You need to worry about knowing what formula are using or using the present value tables, which are given to you as a tool in the software when you're taking the exam. Most of the time, they're giving us the factors, though. Okay. Okay, good. Let's just go ahead and take a look at a couple questions. Okay, looks like most of us have had a chance to try this one. And 67% of us got it right, but I think I'm going to ask for some participation here because you guys are a little too quiet tonight. So 3 folks thought that choice C was correct. So I'd like to hear some reasoning on those that pick C. Which of the following statement about investment decision models is true? And the answer here is B, but let's just, since there was a little bit of a tie for C, the net present value method says to accept investment opportunities when their rates of return exceed the company's incremental borrowing rate. Where'd that come from?
It's been a long day for me. My read comprehension is kind of shot today. So, but after I selected it, I kind of realized the company's incremental borrowing rate's incorrect. It should be probably
Whatever the company has determined is the required rate of return, right?
yeah.
Which is could be the weighted average cost of capital, but whatever management of the board of directors is selected. So incremental borrowing rate would be a very small number, right? I don't even know what incremental borrowing rate exactly means there, but it would be some amount over a certain amount, I guess, which no, because what about I don't even know what incremental borrowing rate they're talking about there. So, okay, thank you, Don. Anyone else? Okay. The discounted payback rate takes into account cash flows for all periods. That's the problem of all the discount, all the payback, both discounted and not discounted. Any cash flow that comes in after is not considered. So I don't know if that's, we're picking A because we're not seeing the entire screen or not on that one. What was the other one here? I don't know if anybody picked D. The internal rate of return is to accept the investment at the opportunity cost of capital. I don't care. Some of these sound to me like somebody that, got drunk and then started trying to write answers to CPA exam questions. So I can't explain some of these. Okay, guys, let's focus on what we've learned and see how to apply them to questions. That's the exercise here. Okay. All right, let's look at that's our job right now about now. So let's just go ahead and let's take a look at this next one. Okay, guys, we're over 2 minutes. I've got about I got one person not choosing. Okay, there goes one person. Okay, all right, good. Let's go ahead and look at this one. And yeah, okay, we got a pretty good turnout on this one. 75% of us wanted to take A, which is the correct answer here. And so when you take a look, a couple folks also wanted B, but maybe 3 of us wanted B. But let's take a look at this. Which of the following statements is true? It does not consider the time value of money. Yeah, okay, and maybe you were steered away from A because you said, well, wait a minute, we looked at a discounted payback method that did consider the time value of money, but the problem didn't say the discounted payback method, you said the payback method, which would imply it's not discounted, so it's not considered the time value of money. B, which 3 of us wanted, is the time required to recover the investment. Yeah. And earn a profit? No, we did not consider cash flows after the initial investment was recovered, which would not be a profit zone. It would be the profit zone would come after that. We recovered the initial investment. So B is absolutely the opposite of what we're doing here. And I don't think anybody picks C or D. Now D, the salvage, because we didn't talk about this at all in the examples, the salvage value of old equipment is ignored. Payback method would consider the salvage value of the old equipment. So we're going to sell some old equipment and get some cash flow in on that. Well, that's a head start. That's in effect reducing the initial investment, which will affect the payback period. Okay, the thing that you would ignore is the salvage value of the new equipment, because you're not really looking to evaluate a project. You don't want to have to wait until you sell off the old equipment to recover till you sell off the new equipment. By then it would be old to recover the investment on the new equipment. That would be kind of a silly project to get involved in. Okay, all right, good. Let's look at question 3 here. Okay, guys, let's go ahead and look at this one. We're a little under the 2 minutes, but it looks like most folks have already chosen this one and everybody got it right. Okay, so let's look at this though. I know we've got a high batting average here with everyone getting it correct. And we look at these projects and they say which ones will pay back within 3 years. So you look at these, of course, individually. And the first one is pretty straightforward in that project A here, and that when you look, it's an even cash flow of 3,000 per year. So you take the initial investment of 10,000, you divide it by the 3,000 that's going to be coming out, and you get obviously 3.33 something or another. That is not going to make the 3-year cutoff, so that's one is a no. Okay, so you know that A cannot be part of the right answer right out of the gate, so you're down to a 50-50 chance of getting this thing right. So then you look at, and what I would suggest is, since project B shows up in both of the remaining 2 choices, then it would make sense to me to look at project C right now. And so when I look at project C, there's a 10,000 initial investment, and you're going to get what? You're going to get 5,000 in year 2, and you're going to get 5,000 in year 3. So at the end of year 3, yes, you would have completed. So you know that C has to be part of the right answer, and you really don't have to calculate project B at that point, because you know C is in, and B is the only remaining answer that has project C in it. So, but let's look at the other one, just, for fun here, higher education purposes. I guess project B, what, 15,000 in year 2, 15,000 in year 3. Yeah, by the end of year 3, we've got 30,000, and then we only put in 25. So we confirm that project B is correct. Question? Okay, guys, I'm going to end class there. I want to say something. I really want you to really start becoming more actively involved in what we're doing here. The best way that you're going to get through this stuff is to apply yourself to the materials we're going through it. Okay, so what I'm going to do is I'm going to end class here. I'm going to ask that you bring some renewed energy next time, because we're going to start to get into cost accounting, and cost accounting is a 15-point area. So, do some push-ups or something before a class, or drink some water or some coffee or something like that, because I need you to bring that energy, guys. You are not going to have a better opportunity to pass the CPA exam than what you're doing right here, right now. It's not like, God's going to come down next, year and say, okay, now you're ready. Okay, this is the time. Okay, so I want you to kind of think about that, get caught up with chapter 2, and we will at least start chapter 3. We may even finish chapter 3 next time with the very important topic of cost accounting. So be ready. Question? Concerns, thoughts?
I still haven't received my book yet. I don't know what's going on with that.
Okay. All right. Please send me an email. We're going to see what the hell's going on with that. Anybody else in that?
I got 2 books.
Okay. Well, save one for,
Send it to Donald.
Me, please.
no, it's all right.
Okay.
Just,
I think one
I
of
hear
them's
they
practice.
burn well.
One of them's practice tests, and one of them's like the actual textbook.
Setting it? Yeah, you should get 2.
Yeah, one of
You
them's
get the
practice
final
test.
review and the big book and the little book. One is thin, one is thick. This is the big book.
Yes, so technically I got 3, a thin and 2 thick.
Thin and okay, but did you get did you redeem the final review book? You should be getting 2 books per class, but you shouldn't have redeemed FAR yet, because I didn't, so I'm not sure how you got the FAR book.
No, I didn't redeem FAR. I currently am sitting on an actual collection of 4 BEC books, because I signed up for Surgent a while ago. So now I feel like, okay, that means I'm clearly supposed to be studying for this test.
And I don't care about no surgeon, but I mean, to me, the name alone should tell you surgeon. I mean, it sounds like, something that, some sort of procedure that they give to you in the ER room. I was bleeding, so they gave me a surgeon. So, but having said that, the Becker books, you should be getting let me show you, just to make sure we're all on the same page. This BEC. Hang on, guys. Okay. See, final review book is. Well, I can't find my BEC final review book here, and I doubt you guys want to sit here and watch me struggle through my bookcase, but okay, this would be the example of the final review. Okay, it's a smaller book. It looks something like this, but in the case of the BEC, I think it's green. Can someone confirm that for me?
Yes, I have that. It's green.
Okay. Right, it's a smaller book, and then the bigger one looks like this. The one that we're using for the main textbook. You should have received both of those by now. Has anyone except besides Donald not received that? Okay, so Donald, I need you to, something's going on there. You redeemed it, right, in the software?
Yeah, I redeemed in the software. I emailed them a week ago and they said that it's processing. And they also didn't send me the final review book for audit either, which I ordered. So I only got one textbook from them.
Just the auditing one?
Yeah.
Okay, well, send me an email. I'm gonna get somebody to call in on that.
Okay.
Send me an email and remind me, and I gotta talk to him tomorrow anyway, so.
Okay. I'll do that.
All right,
All right, cool.
anything else, guys? All right, think hard about that little speech I gave you at the end. I need you to be actively involved in this stuff, guys, so keep up on the homework, but not more importantly, less importantly, frankly, but also, you gotta be trying this stuff as we go along. It's not gonna help you if you just sit here and let me babble over you all night. And it might help you, but it won't help you as much. So be ready, because we're going to be covering some heavy topics in the upcoming chapter. Chapter 3 is heavy on the exam. Okay. All right, guys. Have a good rest of the night. I will see you next week.
All right, thanks, Professor.
Thank you.
All right,
Have a
guys.
good night.
Have a good night.
Have a good night.
Someone calling me? Okay, guys, I'm going to stop the recording and I'm